What's up, everybody? Mo Comma Sunday service. Today, we are going to be talking about shorting stocks and how to make money when stocks fall, specifically because of what the market's doing right now. Who am I? I am Omar Reed. I am an attorney that happens to trade and invest in my spare time. I have about a couple $100,000 in the market and retirement accounts and trading accounts. And so I am constantly looking at the market to make some extra money on the side. And I've been looking at the market for at least the last 5, 6, 7 years through investing and more so trading over the last 3 or 4 years, right? So, what is shorting the market? Simplest explanation is when stock prices or ETF prices or indexes go down, there are people that are making money when that happens. We all have to remember that there are two sides to every single transaction. If you are buying something, somebody is selling something. If you are selling something, somebody is buying something, right? So if you sold something at the height of the market, there was someone that bought at the high of the market, right? So how do you short stocks, or how do I short stocks? So from a simple explanation, if you have a platform like Thinkorswim, Charles Schwab, Fidelity, Robinhood, there are a million, Tasty Trade, million platforms out there, E-Trade. Um, the first way, number one, is to borrow shares. Then you sell those shares immediately. Then you buy them back at a lower price. And then you return the shares that you borrowed. And you get to keep the difference between the price that you return the shares and where you sold them. Right? So this is the old school OG method for shorting stocks when they say to short a stock, right? You are essentially borrowing shares from your platform, from your Thinkorswim, from your Charles Schwab. You sell them to someone, you buy them back at a lower price, return the shares, and then keep the difference from that amount. And that's how you make money. But note, if you buy those shares back at a higher price, you lose money. And so if you sell shares and the price of those shares go up, you will have to buy them back at a higher price, which means you have to return them at a higher price, and you're going to lose the amount of money from that difference, right? So that's essentially your trade didn't go the way that you wanted it to go. You thought the price was going to keep dipping, and it actually went up on you, and you had to buy those shares back. And so that's how you lose money shorting stocks, because the stock didn't go up, or I'm sorry, the stock didn't go down, it went up. The number two way, and this is from options, and I'm mostly telling you how I trade, how I short the market. I do not short shares. I tend to buy options or sell options, right? So, and the reason why I do that is because your money goes a little bit further, because options are more scalable. They're more you can use less money to control more shares, and so that way they're less expensive to get into. They are a little bit more volatile, but you can buy an option easily for couple $100 when shares of, let's say, Microsoft, what we were just talking about, could be 300, $400, right, for one share. And so you can get way more leverage by buying options than you can buying shares or shorting shares for that matter, right? And so the side that you will be on the option chain is the put side. If you're buying calls, you're betting on the stock price to go up. If you're buying puts, you're betting on a stock price to go down. So if you wanted to take advantage of a stock price falling, you would buy a put, and then you would sell a put later at a higher price. You got to understand that options are derivatives of stock prices, and they have their own prices, right? Essentially, a put is a contract to sell shares at a certain price, the strike price, on a certain date, which is the expiration date, right? And note, if you sell puts at a lower price than what you bought it for, that is when you are going to lose money, right? So that's the number two way of taking advantage of a stock price falling. The number three way that I use is selling calls. And I actually like to sell call spreads, which I'm going to explain a little bit later. But you could sell a call, which is betting on a stock price to go down, versus buying a call, which is betting on a stock price to go up. Essentially, there are two sides to every trade, even when you're dealing with options, right? If you're buying a call, there is someone selling a call. If you're buying a put, there is someone selling a put, right? And these things have their own prices, and they're priced based upon what the stock price is, using delta, using time decay, and a lot of the other Greeks determine what the particular option price is, right? And so when you're selling a call, you're selling a contract to buy shares from me, right? So essentially, I'm selling a contract to buy shares from me at a certain price, the strike price, on a certain date, right? And if you buy these calls back at a higher price, you lose money. When you're selling calls, you're essentially selling premium, and you're selling it for a higher price, and you're hoping to buy that call back at a lower price. So in terms of number three can be broken up into three different categories. You could sell naked calls, which are extremely risky and dangerous, so much so that most platforms will not allow beginning traders to sell naked calls, right? Because there is unlimited downside for selling naked calls, because a stock price can go to infinity. So if you sell a call on, let's say, SPY or Apple or Microsoft, that could go to 1,000, it could go to 10,000, just hypothetically speaking. And so you can have unlimited downside selling naked calls that aren't secured by anything. And so typically, your platform is only going to allow you to lose so much money before it closes your trade for you and makes you put in more money to cover yourself if you are selling naked calls, which is why most platforms don't allow beginning traders to even do that. Number two is you could sell covered calls. In order to sell covered calls, you would need 100 shares of whatever stock or ETF you are selling covered calls on, in order to sell a covered call. And that's per contract, because one contract of an option is worth 100 shares. So you would need 100 shares of SPY or Microsoft or Apple in order to be able to sell covered calls. And then you would only be able to sell one contract per 100 shares that you own, right? So if you had 1,000 shares of Microsoft, then you could sell 10 covered calls. If you had 500 shares of Microsoft, then you could sell 5 covered calls, right? And the reason why these are not as risky is because you already own the shares for which you are selling options on. So there really isn't unlimited downside. You just essentially have to turn over the shares that you already own, right? So people do this, especially in their long-term accounts, if they own 100 shares of something and they don't think the stock price is going to keep going up, like if it hit an all-time high or a place where they might potentially want to think about selling it. They'll sell a covered call, and they can make money while still owning 100 shares of something. While the stock price is dropping, they can make money off of shares that they already own, right? The number three way, and I think this is the least risky, least expensive way to take advantage of a stock price dropping, is to sell call spreads. However, selling call spreads requires you to know a little bit more about options. It requires you to know how to really get in and out of trades a lot more quickly, and just a little bit more education on options, because you are simultaneously selling an option and then buying one at the same exact time, right? And when you're buying the call that is lower than at a lower strike price, and actually not a I'm, I forget the strike price, at a lower value. So let's say you sell a call at $1.50, and then you buy a call underneath it out of the money at 50 cents, then your spread price is going to be $1, right? And so that 50-cent call that you bought is going to serve as a hedge to the one you sold at $1.50, so that you're not naked. And this is the least risky, the least riskiest trade that you can make when selling calls, but your upside is also limited, right? You're going to have a capped upside because of the hedge that you put on by buying a call beneath it, right? And so, yes, this is a little bit more complicated. It is a little bit more technical, but I would say it's the safest way to take advantage of a stock price falling would be to sell call spreads, right? And I'm going to show all three of these to you, right? So on Thinkorswim, that's the platform that I use. Let me go to that. Share my screen. Hold on. Oh, can you guys see it? Or am I tripping? Hold on. Can you see Thinkorswim?
Yes.
All right. So the first method, if you were to just short shares of a stock, right? If I'm just going to use SPY, which is an ETF alternative of the S&P 500, which represents the general stock market. Just looking at the technicals when we were looking at this last week, right? I'm going to zoom in a little bit. We are below this 200-day moving average. And this is one of the reasons why I'm talking about shorting, is because all of the major indexes right now are below a 200-day moving average. And I'm starting to see the shorter period moving averages cross over, which gets me a little bit more bearish on the market than I was last week. I'm also going to show you what the sectors are doing later, and a lot of them are trending negatively. So from a swing trading standpoint, which is what I do, I don't day trade as much, but I'll swing trade over like a 1, 2 to 3 to 4 week period for a particular stock or an ETF or sector. And what I'm seeing right now is that most of these names are trending negatively, especially after all of these tariff announcements and whatnot. So I'm waiting on big pops to the upside. In fact, if I weren't working so hard on Friday and we're looking at the market, I may have entered some names on Friday after this big climb up that we saw. Especially if we get closer to this 200-day moving average, just looking at SPY, I would look at probably shorting it, coming down right there, looking at this to serve as resistance, the 200-day moving average, right? But let's say if I wanted to short shares of SPY, this is what I was saying, that it can be expensive. SPY shares are $562, right? So in order to short a share of SPY, you would need at least to have $562, which is pretty expensive to just have one share or to sell one share of something. And then also, when you so if I were to right click my screen and then click, let's say sell with stop, right? If I were to short, actually, let me take this off. Let me just do a single order, right? So if I were to short 100 shares of SPY, this is how I would do it. I would put in an order to sell 100 shares that I don't own. What that would tell the platform is that I want to borrow 100 shares of SPY. But in order to short 100 shares, I would need, what, 567 times 100? What is that? Is that $50,000? I think that's not five. That's 50,000. Yeah, I would need $50,000 to short that, right? So I was like, damn, I would have to have a lot of cash to short that. So let's say if I did 10, I would need $5,000 of cash to short 10 shares, right? And maybe I only have $1,000 in my account. Maybe I can only short one share. So I could short one share, but I'm not going to get a lot of leverage for my cash. I'm going to need this to fall a really I'm going to need this to fall to a really low level in order for me to make a decent amount of money on this stock, because I only am taking one share versus 100 or 10, right? Taking more size, and I may not have that much cash. So, but what I could do is if I can confirm and send this, let me actually put this a little lower. It's after hours, so it shouldn't send, but let's put this at 500, right? Like, if I confirm and send, I just want to show you what the platform is going to do. It reject. Hold on. Let me redo that. It's going to do one share. Let's say if I want to short it when it gets up to let's say 570, which is where the around the 200-day moving average is. I'll put that into the price, confirm and send, right? And you'll see it's waiting there, right? Sell SPY if it gets to 570. And I really want to show you execution, because I feel like a lot of people who do YouTubes and podcasts don't show you literally how to buy something. That's how I would buy it, right? Or how I would short or sell it, which is telling the platform when SPY reaches $570, sell one share of SPY to someone, right? Which means borrow the share. I'm going to borrow it from Thinkorswim or from Charles Schwab, and then I'm going to sell it for 570 bucks. And if my target was, let's say, 550, then my goal would be to buy back these shares at 550, return the shares to the platform, and then make the $20 difference between 570 and 550, right? And so this is what I mean why you don't have much leverage if you're not shorting a bunch of shares. If you're only shorting one share, you're risking you're essentially risking money if your target was 550 to make $20. And I don't know about y'all, but $20 is not going to move the needle for me, right? That's McDonald's or Burger King or Chick-fil-A or whatever, right? That's one meal, right? So I need more leverage, but I don't want to put up 570 bucks just to make $20, right? So that's why I don't really short shares. But with shorting shares, you don't really have anything called time decay. Your biggest issue is the borrowing cost. And for something like SPY that is highly liquid, that millions of people, I'm not going to say millions, I don't know if it's millions, but a lot of people are trading every single day, the borrowing costs on SPY are going to be relatively low. Versus if you were trying to borrow on GameStop or AMC, right? If you're trying to borrow on AMC, one of these meme stocks, the borrowing cost is going to be really high because it's hard to locate these shares. What's GameStop? Stop. What's their ticker? GME. Same thing on GameStop. One of these meme stocks that has these massive peaks and valleys. If you were to try to short the shares on GameStop, the borrowing cost might be so high that you would need a really big move in order to make money on a stock like GameStop or any other of these meme stocks that go up and down based upon somebody on Reddit or Twitter saying something, right? So that's shorting stocks. That is shorting shares. Another way to take advantage of a stock price going down, number two, would be to buy puts, right? So when we're looking at the option chain, specifically on Thinkorswim, if we start off at the charts tab, you would go to the trade tab, make sure you're on all products, and then you're going to see the option chain, right? If your window is completely collapsed, it's going to look like this. You're going to pull down this arrow, and then it's going to give you all of these dates, which are expiration dates. These are the dates that the contract that you are buying or selling expire, right? I tend to go to the third Friday of every month, which is what we call OPEX, or options expiration. Is when the most options in the entire stock market tend to expire, because if you look at SPY, SPY has 0 DTE options, which means they have options that expire every single day of the trading day. There are some stocks that don't do this. There are some stocks or ETF that only have options that expire on the third Friday of every month, like XLI. Actually, no, these are weekly. There are some that are even worse than this. I think John Deere. Actually, this has weekly options. There are some that have monthly. There are some that have weekly. But as you see with a SPY, with a QQQ, these are going to be some of these ETFs that are essentially index equivalents that are going to have 0 DTE options, where they're going to have options that expire every day, but your less liquid names like an XLI, which is the industrial sector, or John Deere, they're not going to have 0 DTE options, and you're going to see most of the liquidity tends to be on that third Friday of every month, which happens to be March 21st of this upcoming week, right? And I'm always wary of OpX because that Friday weird things can happen. So I tend to try, and if I'm in a swing trade, I'm probably going to close it out on March 20th, the day before, just because things can get a little screwy on March 21st. The only exception to that would be if I'm like really up on that trade, I might let the runners that I have ride all the way into OpX if I've already scaled out significantly of a particular trade. All right, but let's go back to SPY. Right, if I'm going to OpX date on March 21st, if I were going to buy a put, this is how I would do it. Right, so I said 570 is the price that we will be looking at to get in. Right, so I'm going to look at the 570 strike if I'm looking to get into something close to at the money. By the time SPY rises to the point to where I would want to short it, that price would be 570. And so we see here in the option chain that it's deep in the money right now. Not extremely deep, but deeper in the money. So if the price is going to get up to 570, you're going to see that this strike price is going to move to where 563 is now, approximately. And this is how I can gauge at approximately how much this option is going to cost at or around the time or the price that I actually want to buy it, right? And we're on the put side here, not the call side, right? So I know that this 570 option, which is currently priced at $1,267, $12.67 times 100. That's the current price for it. When the stock price gets to around 570, I know that it's probably going to be costing me around 785 bucks to get into SPY, right? That's just me with my experience reading options and how they're priced. I know that around the time that I want to short or I want to buy puts, that it's going to cost me approximately $785 per contract, depending on what my budget was, right? So let's say if my budget is around, what's 8 times 3? Let's say it's 2,400 bucks. If my budget was 2,400 bucks, I know I'm going to be able to buy approximately 3 of these options with my current budget when 570 gets closer to where 563 is now, right? And so what I would do is I would click on the ask side. That means you're buying. If you click on the bid side, that means you're selling, right? I would click on the ask side, and what I would do if I wanted to make sure that I'm buying this at or around this price, like if you want to kind of set it and forget it, and that's your price to get in, then I would put in $7 and approximately 85 cents. And if my budget was $2,400 approximately, I would buy 3 of those, and then I would click confirm and send. And then I want to show you what it does, right? And we're after hours, so this shouldn't execute right now, which is why I'm not scared of it executing. All right, I'm going to confirm and send. And then if we look at the stock price, look at that. right? Even though I'm using options, because I kind of know what the prices are going to do, right around that 200-day moving average, it's going to buy three contracts of SPY um, with the expiration date of March 21st, 2025 at the strike price of 570. And you see right there that the entry price is just above where that moving average is, because I told you that's where I want to get in, is right around 570, right? And another way to do this would be to right click the option, click on copy, right? Because all of these options also have their own chart, and then paste that into the ticker symbol, right? Where is it? Oh, here it is. I'm tripping. Right? And then if I zoom in, what happens is the option price right now, which is at 1220, it's saying when it falls to what did I put in? 785. That's when I want to get in to this particular option. And this is kind of how you would like, so, and then, so what I do sometimes too is I'll put two screens up, right? I'll put the option price itself, and then I might put SPY itself there. SPY on a chart, just like that. And so you can have the option chart up, and you can have the actual stock price or ETF chart up itself, and your order will be on both of these screens, so you can kind of approximate when your order is going to trigger. My order is approximately going to trigger when SPY gets to 570, and my order is going to trigger when this particular option price gets to 785, right? Just to show you what it looks like. And if you want to cancel that order, all you got to do is click the X, right? Then it cancels it on both charts. All right. That is buying puts. Now, let's see. Let's go to SPY again. If I wanted to sell a call spread, what I would need to do is be on the call side of the option chain. And then this is what I was saying. I would want to be on the bid side and sell. And actually, let me make sure I sell the right one, because I want to sell when we get to 570, right? So if I want to sell at around the money, what I would do is I would take this one right here. And then I usually go two strikes down. And so essentially it would be a higher strike price, but for less money. So if I'm taking the 570s, then I would buy the 572s, right? And I, on a Mac, I'm not sure what it is on a PC. It's probably Shift or Control or Option. But on a Mac, you would click Control and then click the ask side, because I'm buying this option. And as you see, it gives me what the spread difference is between the one that I sold and the one that I bought. This price is going to be a little bit off right now because we are after hours, because it's the weekend. It'll be more accurate during live trading hours, right? But essentially it's this price right here, the bid, minus the ask price, two options down, right? So I'm selling this call, and then I'm buying this one as my hedge, and then what I get to keep potentially if this expires worthless is the 62 cents. So if my budget once again is $2,400, I'm gonna sell $2,400 worth of these, which might be what, like, if $62 divide whatever 2,400 divided by 62 bucks is, that's how many options I'm going to get. And for me, I usually like my spread price to be over $1, just because the platform charges you per option. At least my platform charges you per option that you sell and buy. So I don't usually like to have like 40 of these. I would rather have like no more than 10 or 12 of these. Otherwise, like, I'm going to lose some money buying and selling from the commissions that the platform takes when you buy or sell options. So I usually like, I'm just doing this as an example, but I usually like my spread price to be over $1. A lot of times I even like it to be $2 and up so I could buy less, give the platform less commissions. And as long as I can buy more than four so that I can scale in and out and leave some runners, I'm usually fine with having a higher price between these two, right? But that's essentially how you would sell a vertical, right? And in terms of, see, what I do again, because I have like experience, I would look at the difference between this price and this price, which is currently in the money. So we got 618 minus 520, so about $1. So I know that when this gets to about $1, right? Let's do 10 of these. That will probably be around that 570 price, where I want my trade to trigger. So watch, let me confirm and send. Let me go to my chart, zoom in, confirm and send. Right? There you go. Around 570 again. And it's not magic for me. It's just like I understand like the option chain a little bit better. So I'm able to kind of pre-plan my trades and what the prices of the instruments that I want to trade, where are they going to be when the stock price gets to a certain level. Because while I am trading these individual options themselves, I'm using them as a proxy for the actual price of the stock or the ETF that it's tracking. So if I want to short this thing at 570, I need to know what the approximate prices of these options are going to be once they get to that level, once this gets to 570. And I can tell based upon where the current stock price is trading and the type of trade that I want to take. I know that that current thing right now to enter is at about $1, 618 minus 520. So I want this to be $1 difference when I get into it, which means that these will probably have moved up to here. And so by using that approximation, I can tell that, hey, this is the approximate price of the spread that I want to enter if this thing pops up to 570, if that's the price that I want to short it at, right? Something else, just in terms of pro tip, especially when I'm doing spreads, I want to make sure that there's enough open interest. Go look at my video on how to put all of these different filtering mechanisms and tools on your option chain, because these are all of the important things for me to kind of understand what an option is doing. And one of the most important things for me is to see what the liquidity of the option is. I'm not so worried if I'm trading QQQ or SPY options, because as you can see, these are the most like heavily traded things in the world. So there's plenty of liquidity. For me, I always need more than 1,000 open interest, people willing to buy and sell with you, to make sure that I can get in and out of a trade really quickly. Also, when you see the open interest this high and this high, there's going to be very little difference between the bid and the ask, which means you're going to be able to get in and out of a trade really quickly. You could even do some market orders with these options, because you're only losing 3 cents of slippage, because SPY is just so liquid, right? And this price might even be closer when the market is open. It could be a cent or two difference, which I've seen on SPY. So you can get in and out of SPY relatively quickly, right? So that's how I would sell a call spread on SPY if I'm looking to short it around this particular area at 570, which could be some potential resistance. And it's a nice round number, which is what I like shorting at, where people tend to buy and sell at nice round numbers with zeros, right? So once again, you can click that X. Also note, if we're selling, our trade is predominantly bearish, or we're selling something, then this is going to be red instead of green when I was buying puts, right? When I was buying puts, this showed up as green. When I'm selling a call spread, which is the predominant trade, which is selling a call, selling premium, it's going to show up as red, right? If I'm shorting. Same thing, if I'm shorting shares, this is going to show up as red. If I'm buying shares, it's going to show up as green, right? You can click the X to cancel the trade. All right. So that is my tutorial on how to short the market. Those are not the only ways to short the market. You could short it with futures too. I don't trade futures, but I'm just showing you what people say or what they mean when they say I'm going to short the market, right? They're either shorting shares, they're buying puts, they're selling calls, they're selling naked calls. If you're a live, if you're an expert and you got a lot of money, you can sell naked calls. They are selling covered calls if they own the shares already, or they're selling call spreads, which I just showed you, which is the least risky way to short the market, but your upside is going to be limited versus if you're buying puts, your upside isn't limited as much. And just as a pro tip, what I did on a trade, it was a losing trade last week on XLP, which is why I am focusing mostly on shorting shares or instead of on XLP last week, I sold a put spread, which is a bullish trade, and I also bought a call at the same time. And so now that's kind of what I'm doing is like if let's say my budget is $1,400, I might sell $1,000 worth of call spreads and then buy $400 worth of puts, so that way I can hedge my risk with selling the spread, but also take advantage of some of the upside that buying puts would bring, because you can make more money buying puts, but you could also lose more money buying puts. So I might have a smaller budget to buy puts and then a larger budget to sell call spreads, and then use those leftover puts as my runners, and or the first thing that stops me out, uh, and keep the call spread position on a little bit longer because time decay is on my side. I might be able to stay in a call spread position longer than I can stay in a position for just buying puts, because buying puts is going to be more volatile. I can make more money, but I could also lose more money. Right. So I've been kind of mixing up my trades a little bit more so that I can take advantage of like the upside of buying puts while at the same time take advantage of the risk allocation of selling call spreads or selling put spreads, where I can stay in a trade for longer. I can make money off premium, and they're just going to be less risky because they're defined risk trades, and I'm hedging them by buying a call or buying a put below where I'm selling the call or put. Right. All right. So, can you guys see my screen? Back to the presentation. So, my weekly stock picks for this upcoming week, particular sectors that I'm looking at, right? My disclaimer, which is always in my notes and my description for the videos: investing is risky. This is for informational purposes only. I am not a licensed financial advisor. You should direct all your trades and investments to your licensed professionals, and trade at your own risk and do your own research, because you can lose money in the stock market. Don't let anybody say that I never told you that, right? So how do I build my watch list? I typically go to this free app called koifin.com. Then I go to the market dashboards here, then go to the US sectors, and then I have all of the sectors that I trade typically checked off, right? So if we're looking at over the last month, what has been performing well? Nothing. That is why I am doing a podcast, a video on shorting the market, because the only thing that has been doing well is gold. That is the only thing that I'm seeing right now that has been doing well. XLP, even the consumer staples, was up there last week, which is why I took 2 trades last week on that sector, but that didn't go so well for me because the whole market right now is pretty much negative. Energy is the only thing that is barely crossing that 50% mark or that 0%, other than gold and gold miners. So I am focused this week on shorting things that pop up. So I like to beat up on the weak. Just like if I'm going long, I like to take the strong names on a pullback. So I'm not waiting for a pullback on these names. I'm waiting for them to pop up. And as I indicated, Friday would have probably been a good day for me to enter into these names if I wasn't working so much and I wasn't able to watch the market. But we had a big up day on Friday. So, what I would like to do typically on big up days is look, XLY is weak. The two strongest names, or the two most heavily weighted names in XLY, are Tesla and Amazon. So XLY itself, Tesla and Amazon are at the top of my list to potentially short next week on big pops up to the upside, right? I also use a volume indicator to kind of figure out where I think I want to short something. But XLY, Tesla, and Amazon are on top of my list to short. KRE, the regional banks, and the Russell, uh, the small caps, those are also top of my list to short because those are really weak right now. Tech itself, in addition to the semis don't look good. Tech itself looks pretty bad. So on an upside, if we have another big up day next week, I'll probably try to take a short position on XLK names or SMH names. And then you got some other names that are bad: metals and mining, XLC, which is Meta and Google, the financials. Everything looks pretty bad. But what I want to take to the downside are the worst looking names. So I'm going to focus mostly on the top four worst sectors: XOY, which is consumer discretionary; KRE, the regional banks and the Russell 2000 index through IWM; XLK names, XLK itself, and then SMH, right? Those are going to be the four sectors that I focus on next week if I want to take something to the downside, right? So let me go to my flexible grid. I actually need to update some of these names in terms of the weightings, right? But look at XLK. I wouldn't necessarily take Apple to the downside unless it keeps breaking these lows, because Apple is kind of neutrally trending. It's not as weak. Nvidia, I just don't like to short Nvidia just because it's like, I looked at its earnings. The earnings were good. I would rather short something that's a little bit worse. Microsoft looks better to short. The trend, right? This is a different representation of a 35 or 34-day moving average on this screen right here. Actually, on all of these screens, I like to see that the trend is steadily coming downward versus Nvidia is kind of sideways, coming down and going up. This looks like a worse trend, or a better, I should say, a better negative trend than Nvidia's and Apple. So I would rather short Microsoft next week than Nvidia and Apple, unless Nvidia and Apple kind of come down. Same thing with AVGO. I looked at the earnings. The earnings were really good with AVGO, so I'm not shorting anything with really good earnings, personally. AMD looks decent to short at the price that you and I got in, and so I would kind of use that as a hedge personally. If AMD comes back up to 110 or even at 106 level, I would potentially thinking about shorting it as a hedge, just because look at the trend, it looks relatively negative. The one thing that I would be worried about on AMD shorting it is that AMD, and we talked about this, Ange, is already like 75% off its all-time high. So I don't think it has as much more room to fall versus Microsoft is still at that 20% off, 25% off all-time high level. So I would feel more comfortable shorting Microsoft because it has more room to fall than an AMD does. CRM too looks pretty negative. The trend isn't as negative as Microsoft and AMD. Let's look at Oracle. Oracle, same thing, not as negative. Yeah, my names that I would probably focus on next week would be in this order. I would love to short Microsoft at a pop up, AMD, and then probably XLK, the entire sector itself, are going to be on my list for next week for shorting. Microsoft, AMD, XLK. And let's go to SMH, which is the semiconductor chip sector. We already kind of talked about some of these names. I would rather short TSM over Nvidia because that downtrend looks a little bit better to me than the others. Actually, yeah, that's it. Maybe TSM itself. ASML is kind of neutral right now and it's falling a lot. Qualcomm is trying to neutral. If you look at that moving average, it's not falling as much as like a TSM. Texas Instruments, same thing. Micron, same thing. Look at that again. Remember we were talking about that 87 level I had for Micron? It popped off of it again and came up. That really looks like a long-term level to get into Microns at 87 on a leap. Um, I'm not going to take it because I'm already exposed to AMD on a leap. So I have too much exposure in the semiconductor sector. So I'm probably not going to take another semiconductor name. But that 87 price at Micron looks really good, you know. AMD, same thing in the semiconductor sector. Intel, you'll see popped up because there are some buyout merger talks with Intel and TSM and Nvidia and whatnot. I'm making a call right now. I don't think Intel is going to exist in the next 2 years. You know, in 48 months, I think Intel is going to be absorbed into one of these other names like a TSM, an Nvidia, AMD, or something like that. I think Intel's best days are behind it, and I don't. Yeah, this pop is only because someone is thinking about buying Intel right now, not because they think Intel is a great company. I do think they just changed their CEO too, but I think that's the play on Intel right now. Is if you're playing on Intel to be bought by somebody. That's SMH. What else did we talk about? XLY. I don't have a chart for XLY because it's heavily concentrated inside of. Look at XLY. Doesn't look good, right? XLY does not look good. Tesla is one of the most heavily weighted. Tesla does not look good. Um, I've been telling y'all at that 300 level, I'm so pissed that I was busy that day with trial. I did not get in right there. Literally hit my level a few dollars above and hasn't come back, right? And this would have been a great sell point down here. Like if you would have shorted at that point when I was telling you to, you would have made a lot of money. Amazon is on my list for next week in addition to Tesla on a big pop up. Look at Amazon. Look how weak that is. Those are the top two names inside of XLY. And then XLY itself is weak. So I would put those three on the list. What else is an XLY? I feel like Home Depot is an XLY. Yep, Home Depot is something that's potentially that could be shorted as well. Also, I think this is the third most heavily weighted name in XLY. Let me go double check really quickly. This is how you could tell what is in each sector is by Googling the holdings in that particular sector. Top two in XLY, Amazon's 21%, Tesla's 12%, Home Depot is 3%, McDonald's is 4%. Let me go look at McDonald's. That's the only other one. No, I don't like McDonald's. McDonald's is kind of doing the opposite of the sector. So I wouldn't take McDonald's. And XLY, though, I would take XLY itself. That's on my watch list for next week. Tesla, Amazon, and Home Depot. And the last thing is we looked at was KRE, which are the regional banks heavily weighted in the Russell 2000. That looks negative too. Once again, it had a big pop on Friday. That probably would have been a potential day at the end of the or a potential time at the end of the day to get in, which I wasn't looking at the market at the time. Specifically too, if it gets back up to that 200, that's probably where I'll be looking to short it back down close to like 58.45, as well as the Russell itself. Russell itself looks weak. I love it at $2,100, right? A nice round number. Look at all of that resistance right there at 2,100 too, and old support. So if the Russell pops up to 2,100, I would love to short it at 2,100 to come back down. And I would do that through the IWM which is going to look exactly like the Russell. And so the price on IWM would be around 205, which is where it matches up with the Russell. So I would look to probably short the IWM at 205, but I will mainly be looking at the Russell to even get in on the trade. I would trade the IWM, but I would be looking at the Russell to get up to that 2100 before I would even think about even looking at what the equivalent would be on IWM. But that's where I'm looking next week. XLY, Tesla, Amazon. XLK, Microsoft, AMD, SMH, TSM, AMD, and then KRE and IWM shorts. That's what's on my list to swing trade to the downside next week to short the market if we keep seeing this downturn and we keep waffling back and forth on tariffs and what that's going to do to the market. I think that's what's affecting the market the most is this uncertainty with what are we putting tariffs on Canada or not? We putting tariffs on China or not? We putting tariffs on Europe or not? Right? And then how are they retaliating? And until we kind of solve that uncertainty, I think there could be some more potential downside coming. I could be wrong too, but for me, I am focusing on following strong trends. The strongest trends right now are to the downside, right? Over the last month, so that's what I will be trading. The only thing I would potentially think about trading to the upside would be gold. But I do think gold is a little overcrowded, but gold is hitting all-time highs right now. So gold would be the only thing I would think about taking to the upside. Everything else, I'm looking at shorting the market. And then this also serves as a hedge to my long-term positions. Maybe if the market keeps dropping, if I can make some money on the downside, then it will brace the fall of my long-term positions in my retirement accounts a lot more. So this is a way to not feel the brunt of that punch of things coming down, is if you're making money when things are on the downside. Right? So that's all I got for y'all this week. Unless you have any questions, concerns, anything like that. Anything you want to look at. And then, Ange, you asked me earlier about my price on Microsoft. It is at $340 approximately. That's my Microsoft price.
Okay.
At that approximately, 40% off fib level.
Gotcha.
Between 350 and 340. And we'll look at the weekly chart. Yeah, there's a lot of support and resistance right there. A lot of weekly candles revolving around there. Microsoft doesn't tend to, even when Microsoft comes down, it doesn't tend to have major falls. So even in this point, it fell down 3 fib levels. So if we're here, 1, if it gets down 2, the Godfather price to enter Microsoft would be $300. If you want to be extremely conservative, $300 would be the best price, I think. That's where I would load the boat, but maybe thinking about averaging in around 340, but that 300 price looks even better because if you're looking at over the last 5 years, Microsoft doesn't tend to fall much, but when it did, it only came down like 3 fib levels, so 3 fib levels would be around $300 from an all-time
high. Yeah, which is interesting that 340 is also that 200-day moving average.
Yep. Well, no, this is a 200-week.
Sorry, 200-week moving average.
Yeah, but look, right here, it popped right there, right?
That's what I was noticing, yeah.
Yep, so that's where my price is, through around 340.
Interesting. Cool.
Right? Makes sense, though, right? So I'm not crazy.
Yeah. No, and also, I think this was a good session, especially in this market.
Yep.
I'm going to have to go back and watch it again this week.
Yep, for sure. All right, unless there's anything else y'all want to look at, we done for this week. Mokama, Sunday service, making it rain without the umbrellas.
Awesome.
All right, see y'all next time.
Thanks, man.
Yep, peace.
All right, fellas, I'm out here.